Hello and welcome to Alternative Dispute Resolution in a Pandemic, brought to you by P.R.I.M.E Finance. My name is Camilla Macpherson. I'm Head of Secretariat and I'm going to start the session with some housekeeping. This session is being recorded and will be distributed afterwards. Attendees are muted and have their video turned off. If you'd like to get in touch with us with a comment or question, please use the Q&A function. We'd love to hear from you, and it can be helpful to include your name and affiliation. We'll be in touch with you using the chat box. I'd like to thank Duffie Financial Technologies, FTI Consulting, Morrison & Forster LLP, and Rutter Associates for sponsoring the second series of Prime Time. Thank you also to Lexis and MLEX for helping with promotion and distribution. I'll now hand over to Rick Grove, who will introduce the panel. Rick is CEO of Rutter Associates, a Prime Finance expert and a member of the Prime Finance Management Board. He was previously a fixed income and commodity derivatives executive at Bank of America and P.R.I.M.E and CEO of ISDA. He's also a former lawyer at Cravath in London and New York. Rick, it's over to you.
Well, thank you very much, Camilla. Welcome to everybody. It's my privilege to be joined today by two excellent panelists, neither of whom will require much introduction to you in the audience. Firstly, I'd like to introduce Professor Darrell Duffie. Professor Duffie is Professor of Finance and Professor of Management at Stanford's Graduate School of Business. In addition, among his other professional activities include his fellowship as a member of the Council of the Econometric Society. Professor Duffie is a research fellow of the National Bureau of Economic Research, and he's a fellow of the American Academy of Arts and Sciences. Professor Duffie is a prime finance expert. Secondly, it's my privilege to introduce the Honorable James Peck. Judge Peck is a former U.S. bankruptcy court judge for the Southern District of New York who concluded a distinguished career on the bench by presiding over the bankruptcy procedure relating to Lehman Brothers that began in 2008. After stepping down from the bench, Judge Peck joined Morrison & Foster in its New York office and currently heads the cross-border restructuring practice for MoFo. Well, the pandemic, as we all know, is first and foremost a tragic global public health crisis. In addition to the terrible personal toll that it has taken on individuals and their families, the virus has had wider economic, social, and, as we may witness in the United States a week from today, political implications. Not surprisingly, markets have also been impacted by the virus, most dramatically in March when equity markets crashed and volatility spiked. Moves of this magnitude are bound to impact financial institutions, and the movement that we saw in March was no exception. Several funds got caught on the wrong side of the market moves and the volatility and became insolvent. Our discussion today will center on how one such fund failure led to claims by its dealer counterparties that far exceeded the available assets of the fund, and how an ADR process was structured to enable the parties to settle claims and avoid a lengthy and expensive bankruptcy proceeding. Judge Peck will discuss the circumstances that led to his being engaged to structure and implement this ADR process, and I will join the discussion to describe how a team from Rutter Associates, led by my partner Bob Salvaggio and I, together with our colleagues Jialing Xu and Felix Lee, provided assistance to Judge Peck in this ADR. We will leave time at the end for Q&A, so be thinking of questions and feel free to submit them in the Q&A function as we speak. We hope to have ample time at the end for your questions. But before we turn to Judge Peck's discussion, Professor Duffie will set the stage with an overview of the market context and the relevant financial instruments. Over to you, Darrell.
Thanks so much, Rick. It's not every day I have the opportunity to appear with Rick Grove and the Honorable James Peck to discuss such an interesting set of issues and a very innovative solution to a problem and over-the-counter derivatives markets. So what I want to do is set the table for this feast for Rick and Jim by just reviewing, and I'm sure most people watching today are familiar with the basics, but just reviewing the basics of the swap market, and in particular, the market for variance swaps, which I imagine figures prominently in the discussion that we're going to have. So I'm going to describe what a variance swap is and how these contracts are typically managed from the viewpoint of counterparty risk. And I'm going to share my screen. I don't have very much to show, but I just want to show you in a couple of demonstrative slides how this situation that Rick just described can come to be. I also want to thank P.R.I.M.E for the opportunity to be here, and of course to be one of the members of the P.R.I.M.E experts group. So first, just a moment on the structure of swap markets. So I've used a simple schematic diagram to illustrate how a hedge fund of the type that Rick described might enter an agreement with a large dealer or any dealer to exchange cash flows on a swap. Now in this diagram, as you can see, the dealers are connected to each other. They can trade swaps with each other and do so when they lay off excessive risks in the swap market. But as for the customers of the dealers, which are the blue dots, almost exclusively they trade only with large dealers. When they do, they enter an agreement called a swap, which is an exchange of one uncertain payment in exchange for a fixed payment. For example, customer one could exchange with dealer one, let's say a gold swap, by which customer one would commit to pay, let's say $2,000 in exchange for the price of gold at some maturity date in the future. And if gold settled at $2,300 an ounce, then customer one would receive a net payment of $300. That's $2,300 minus the fixed agreed payment of $2,000. You can sign a swap on just about anything. In the standardized swap market, such as the interest rate swap market, these swaps would be centrally cleared. And the idea of central clearing is that even though customer one and dealer one had initially agreed to exchange those cash flows, each of them would novate their commitments to a central counterparty. And because of that, if anybody failed in their position, it would be up to the central counterparty to make good for it. But going back to the market without central clearing, if customer one or if dealer one were to fail to perform, for example, go insolvent, the swap contract is managed, the workout of it is managed under a master swap agreement, sometimes called an ISDA, which Rick will know all about. And under that ISDA, there's an agreement called a credit support annex, which determines exactly how to manage the net payment due between the two counterparties. All of this can be done in principle outside of the bankruptcy process. And I'm sure Judge Peck will be talking about that. He managed the bankruptcy of Lehman Brothers, which involved in it by far the largest ever swap book that had to be managed out. Now, some customers of dealers have more than one dealer counterparty. And in fact, some recent research from the Federal Reserve Bank of New York by Nina Boyarchenko and collaborators at the Fed recently estimated that a typical hedge fund has around 3 to 4 prime brokers, which typically handle most of their swap agreements, but can have as few as 1 and as many as 7 typically in the statistics coming from the Fed. Of course, it's possible to have an ISDA agreement with more than just one's prime brokers, but the prime brokers tend to do most of that. Now, the swaps that we're going to be discussing today, called variance swaps, which are linked to the volatility of equity returns in the US equity market, those swaps are not centrally cleared as depicted in this diagram. So if customer one, say a hedge fund, entered a variance swap with dealer one, then that would have to be worked out between those two under their credit support annex, or if there's more than one dealer counterparty, as in the case of customer three, Each of those dealers has a claim on customer 3, and that is going to be the core set of issues that Jim and Rick are going to be discussing in a few minutes. For example, as Rick said, the hedge fund in question had an insolvency in which the claims of the dealers far exceeded the resources of the hedge fund, and that presents a severe coordination problem, and that's why we're here today to discuss that. Now, what is a variance swap? Well, let me just walk through that with a simple diagram of the actual payments due on a variance swap and how they were magnified enormously during the pandemic events in March of this year. So on the horizontal axis is the date since December of last year. And on the vertical axis is the floating side payment due on a variance swap in which someone has committed to pay the squared returns on the S&P 500 over the preceding month. It doesn't need to be 1 month, but 1 month is a typical contract in this market. So let me walk through a simple example. Suppose, for instance, that the returns were up or down 2% every day for the last month. So each day they either went up 2% or down 2%. Well, the squared return is therefore 4% a day. And on average over 1 month, that would mean a payment due of 4. Now, 2% a day is quite a lot. Markets are volatile this year, but 2%, as you probably know, on the S&P 500 is a very big day. And as you can see in early December 2019, in fact, I'm gonna zoom in on this picture. In early December of 2019, typically the up or down every day for the preceding month was well under 1% in terms of squared returns. And I'm going to zoom in even more. You can see that all through the early part of 2020, the average of squared returns over the preceding month, which is the payment due on the floating side of that variance swap, was well under 1. Then in February 2020, COVID news started to come into the market, and we saw that number go up to around 2. And so perhaps a hedge fund said, well, gosh, that's a really high number. I think I can absorb a loss of something in the vicinity of 2, and the other side is going to pay me a fixed amount that will compensate me handsomely for taking the risk that this number could get even bigger. Uh-oh. March 2020, pandemic news hit the market big time. The S&P 500 market plunged about 30%, and squared returns grew enormously to the point at which, I'm going to go back to full screen. To the point at which average squared returns over the preceding month exceeded even 40. That's as though up or down returns on the S&P 500 had been like 5 up and 5 down every day for the preceding month, which is ridiculously high, but it was one of the worst pandemic, it was one of the worst financial impacts on the US economy ever seen, and the S&P 500 performed very, very badly. Eventually, this declined. So any hedge fund that had committed to pay these average squared returns over the previous month and had entered that contract near the end of February would have lost a ridiculously large amount of money. And I'm not surprised at all that some hedge funds that decided to take that chance were actually driven insolvent, especially if they focused on variance swaps. Now, there are other volatility derivatives. There are options on these variance swaps. There are things called volatility swaps. I'm not going to have time today to review all the types of volatility-related contracts that are traded in the market. But this is an example of how a hedge fund can get into big trouble. And I'm going to pass it back now to you, Rick, and to Jim to tell us what happened when the hedge fund in question got into trouble.
Thank you very much, Darrell, for that overview and introduction. And I'm going to turn it over to Judge Peck. Before I do, I ought to mention something I neglected to mention, and that is that Judge Peck, as is the case for Darrell and me, is a member of the P.R.I.M.E. Finance panel of experts. And with that extra introduction, Jim, let me turn it over to you.
Rick, thank you. And Darrell, I learned a lot from your presentation. One of the things about being a former bankruptcy judge and currently doing work in the private sector, including mediation, is that you only get to know what you have to know. And I had actually never seen that slide before, nor had I had an explanation as concise and helpful as the one you just gave. I became involved in issues surrounding the volatility points raised by Darrell in around the start of April of this year. I was paying, I must tell you, no attention whatsoever to volatility swaps or variance swaps or complex and sophisticated derivative products. I was simply concerned about my own 401k. And I was paying close attention to what was going on in the markets from a very personal point of view, and I expect that's true for a lot of people listening in. I was contacted by lawyers representing the dealer counterparties, the banks that were affected by margin calls that they had made as to this particular fund and their closeout of the ISDA contracts, the master contracts that Darrell had mentioned. I had no background on this subject whatsoever until I was contacted. And that's also how it works very frequently in mediations or arbitrations or other matters that are brought to prime experts. You have no background on the subject until it's presented to you. I was delighted to get the call. I understood that all of the banks, at that time there were 4 of them, had consented to my serving in a facilitation role, not a mediator, but a facilitator, and that my candidacy to fulfill this position was also acceptable to the fund. I should point out to everybody listening that we are still subject to confidentiality restrictions as to the identity of the dealer banks and the identity of the fund. So we're talking in generalities, but I think the points that we are getting across here are absolutely clear, notwithstanding the fact that certain details are being concealed. The means by which we were brought into the situation was a contract. The banks, and it turned out that there were 6 of them ultimately, agreed to forbear from exercising remedies against the fund. The concern at the time was that there would either be litigation brought to, in a sense, have a race to the courthouse to improve the recovery of one bank relative to other banks, or there would be an involuntary bankruptcy brought against the fund. It's also true that as to each of the transactions in question, and each one was separately documented, and so we had a silo situation in which the fund was the customer, much like the customer 1 in Darrell's schematic, and there were multiple dealers. So you could draw lines to multiple dealers. They had dealer exposure relating to more than the 6 banks that were part of our process. In fact, before our process came to be, there had been any number of settlements worked out between the fund and particular dealer counterparties in the run-up to April 8th. April 8th was the date of the forbearance agreement. The forbearance agreement itself was quite detailed, ran for a 30-day period to May 8th, and specifically provided, to my surprise, that the forbearance was conditioned on my being selected as liquidation facilitator. I was effectively a sole source for stability, at least in this little mini market. And I agreed to do this. I was paid a fee for my efforts. And it was also understood that I couldn't do this alone, that while I had some skill and experience as a mediator, and I had some relevant experience as the former bankruptcy judge who would handle Lehman Brothers and had some familiarity with derivatives, I was not personally equipped to unpack the details of closeouts that had been worked out on an institution by institution basis as to this particular fund. And so it was a necessary feature that I would need to bring in my own expert. And that turned out to be Rick and his firm, Rutter Associates. This is not a pitch for the networking potential of P.R.I.M.E Finance, but the only reason I knew Rick at all was that I had seen him in the context of having attended P.R.I.M E Finance events at The Hague. In fact, we've run into each other on airplanes back in the day when people used to fly. I haven't been on an airplane for quite a while. But we were fellow travelers to conferences in which people like us would appear on panels in real time and talk about issues of common concern. So Rick was, in effect, the first name that came to mind because I knew he had formerly headed the ISDA group, that he had significant legal and business experience. And I didn't know anything about Rutter Associates, but knew they might be a suitable adjunct to what I was doing. Anyway, they were brought in. Rick will shortly tell about what he did working with me and my colleagues at the firm. I couldn't do all this on my own. So this was a pressure cooker kind of assignment because the forbearance agreement, which governed the process, the process was very ad hoc and very bespoke, and in a sense, one that I was, well, given guidance from the forbearance agreement, I was making it up quite literally as we went along. One of the things I needed to do was to validate financial data from the fund itself. And so there was a diligence process somewhat akin to what an examiner would do in a Chapter 11 case. I didn't take on the full list of responsibilities of an examiner, but part of what I was charged with doing was creating an atmosphere of trust between the banks on the one hand and the fund on the other. If the fund was paying other parties junior to the bank's claims, that would have killed the process. So in a sense, one of the things I did was participate with Rick and others in validating the financial reports of the fund and also their records as to what they claimed they owed each of these counterparties, and also what they had paid in settling out their claims with other counterparties before the forbearance period. Notably, each of those settlements and the settlements which ultimately were reached in the context of the forbearance were subject to the safe harbor provisions of the bankruptcy code. And so to make a settlement is to secure that settlement from later clawback risk in the event there might be a bankruptcy filing. And I mentioned bankruptcy filing because it was the motivating factor that led to the forbearance agreement in the first place, and one of the principal motivators of the negotiations that took place pursuant to the forbearance agreement. Everybody involved in this process was eager to avoid a bankruptcy filing. A bankruptcy was viewed as value destructive, expensive, and a source of significant potential risk, both to the fund and to each of the counterparties, and significant delay and uncertainty. The avoidance of that delay, expense, and uncertainty was what kept everybody at the table. We got to the end of the first month, which was now May 8th, and we had accomplished some, but not all of our objectives. And those objectives also included diligence with the bank counterparties, which Rick will be describing. In effect, what I was charged with doing with Rick's help was to validate the calculation of closeout claims by each of the banks, but it was in an environment in which the banks themselves did not have transparency into the claim calculation protocols followed by each of the other banks. And so part of what this process was designed to do was to create not real transparency, but virtual transparency. Each of the banks could rely upon the fact that the process that we were engaged in was sufficiently the same with each institution, with sufficient attention to detail with each institution, that when we got to the end of the process and were able to say, we're done with some modest adjustments to claim amounts, everybody was able to say yes. One additional point, and then I'm going to turn it over to Rick. In addition to the existence of meaningful tension between and among the banks as a class of creditors with separate claim amounts, there was meaningful tension between the banks as a class and the fund as the putative debtor in possession in this hypothetical bankruptcy that we were mimicking. In order to mimic the bankruptcy process, there needed to be at least relative adherence to the absolute priority rule and to making sure that other stakeholders were not favored, but at the same time did not destabilize the entire situation by making a fuss, by litigating, by bringing their own involuntary proceeding against the company. And so there was this tension between the banks on the one hand, the fund on the other, and the treatment of fund stakeholders. And one of the principal points in dispute was how much money would be held back from the pot of cash for distribution to each of the bank counterparties. And that was a major negotiation, which was difficult to conclude. And we got to what I'll describe as the ultimate inflection point, which was June 8th, when the extension of the forbearance that had started on April 8th was about to expire. We had done all of our validation work, and the main problem that remained was how much money would be held back. And there was an ongoing dispute between fund and lenders as to how much the fund could hold. It was resolved ultimately by my sending a memo on June 8th with a recommendation in my capacity as liquidation facilitator. And to my relief, and I think to the benefit of all parties, that recommendation was accepted. And with that, I'll turn it over to Rick to describe what he did, which was a totally invaluable aspect of this. And we must have spoken daily, a couple of times a day throughout this entire period. Rick, tell us about what you did.
Well, thank you, Jim, and it was a pleasure and a privilege to work side by side with you and your colleagues at MoFo, and I and my colleagues at Rutter Associates very much appreciate your having called on us, and also having appreciated the forum that P.R.I.M.E Finance provides that Jim mentioned a few minutes ago, the ability of P.R.I.M E to bring together judges and arbitrators and lawyers, with market experts and economists, academics, and like Darrell, and regulators. It's a deep and broad pool of expertise, and this is a poster child for how prime finance can bring people together to solve disputes. So again, thank you very much to you, Jim, for bringing us in, and to Prime Finance for providing this forum. So when we were engaged by Jim, as he mentioned, this was not a bilateral negotiation or a series of bilateral negotiations. This was a very complex process with, if anything, the banks as concerned or more concerned about where they stood vis-a-vis each other than the fund and the banks were concerned about where they were vis-a-vis themselves bilaterally. That's not to say the fund didn't care about the outcome, but there was a finite pool of assets. And ultimately, within certain parameters, how those assets were allocated among the various bank creditors was not as important to the fund as it was to the banks themselves. The banks being concerned that if any one of them, or more than one of them, was making a claim that was exaggerated, that bank that exaggerated its claim would benefit to the detriment of the other bank creditors. So sorting out those claims and establishing the relative validity of those claims was a key aspect of this assignment, which I undertook with my partner Bob Salvaggio and a team of colleagues at Rutter Associates. We looked at a number of possible ways of establishing the validity of the claims and allocating the pool of assets among the bank creditors. One possibility would simply have been to accept the claims without verification, but I think, as is quite apparent, that would not have been acceptable to any one of the of the bank creditors. So another possibility would have been for us to independently value each of the transactions. There were 90 some odd transactions. They ranged from relatively plain vanilla variance swaps to highly sophisticated, highly structured transactions with a significant amount of optionality, knock-ins and knockouts, and barriers, and multiple underlyings that introduce the correlation of those underlyings as pricing factors. So there's a fair amount of sophistication in these 90 transactions. They were also, although the largest component of them had as their underlying the S&P 500 index in the United States, they also referenced indices in Australia, China, Japan, Korea, and Europe. So there's a great deal of complexity in this portfolio. Had we undertaken evaluation, which we were prepared to do, could have done, one of the concerns that Jim and I had is that we would have, as a result, since some of this valuation work would have included an amount of judgment on our part. I mean, there's a high degree of science, but there is a bit of art to the valuation of these transactions, that we would have risked substituting our judgment for that of the bank dealers. And so it also would have been a very time-consuming and expensive process. So for that reason, we looked for other alternatives, and we considered two shortcuts. One of which would have been to simply allocate the bank's claims on the basis of the fund's own marks as of some date, say March 13th or March 16th. But the problem with doing that is that the fund itself, however robust its marks might have been a week or two prior to the crisis, by the time we got to March 13th, given the volatility in the market, those marks were less robust than they would have been perhaps a week or two earlier, simply because there was a difficulty at that time in getting quotes and for the fund getting quotes and assessing the marks on its position. Also, the fund's attention at that point was diverted by its efforts to navigate the market volatility and its potential insolvency. And so we weren't as confident, and the fund itself wasn't as confident in its marks as of that time. Another possibility would have been to allocate on the basis of the dealer's marks. And for the dealer's marks, we could have obtained, we're able to obtain the dealer's mid-market marks from the collateral statements that the dealers were submitting to the fund on a daily basis. And the collateral statements, which specifically under the ISDA CSA are mid-market marks, are subject to controls that are monitored by compliance, risk, and finance inside the dealer banks, and so give us some confidence that those mid-market values are robust valuations. However, they are mid-market valuations, and as I said, some of the transactions were fairly plain vanilla. Others were significantly more complex and structured, and therefore the bid offer spread that would have needed to have been added to these mid-market values to come up with a fair or replacement value, which is what the claims were based upon under the ISDA master agreement, to come up with those bid offer spreads. Some of those bid offer spreads would have been fairly narrow, others would have been considerably wider. And so the mid-markets themselves, we felt, were not accurate, an accurate basis upon which to determine a claim amount. In addition, between the date on which we had those mid-market valuations, say the 13th of March, and the early termination dates that were specified by the bank creditors, which were largely the 17th and 18th of March, markets had moved dramatically, and the valuations of some of the transactions may have moved in a slightly in a smaller way, and even against the banks, and others moved quite dramatically in favor of the banks. So we decided that even though that would have been a very simple basis upon which to determine the allocation, it was not an appropriate basis. So we opted for what I would call a more hybrid approach, or a due diligence approach, where we reviewed each dealer's methodology, each dealer's models, each dealer's data inputs to those models. We had multiple discussions with each of the dealers about their methodology and models, and about the data that they were using. We requested a significant amount of additional information from each of the dealers, data and explanations. And we also undertook a valuation of a sample of transactions. So we valued not all of the transactions, but some of the transactions to assess the reasonableness of the methodology that each of the dealers had employed in calculating its claim. And in conclusion, after, as Jim described, a significant period of very intense work that stretched beyond what we had hoped would be a 1-month period to a closer to 2-month period, we came to the conclusion that much of what the dealers had done in calculating their claims was commercially reasonable, but that was subject to some adjustments that we recommended. And so, Jim, that's the process that we undertook, and the conclusions that we came to.
I'm going to make one further comment. This was all happening during the pandemic, and so, consistent with the title for this panel, there were some challenges associated with this that simply had to do with getting information, processing information, lots and lots of telephone conferences. We had talked a little bit about whether or not something like this required a Zoom approach of the sort that we're using here for this panel, and actually only used telephone conferences, some of them involving 50 or more people, because we were dealing with bankers with offices all over the world, some simply very small institution by institution conversations. It was a process of incrementalism leading to credible validation of each of the separate claims and a credible assessment of risk. And part of the risk assessment involved the cost of a hypothetical bankruptcy. And there was a general agreement among all parties that the bankruptcy process itself would be extremely expensive. And without identifying a value, multiple millions of dollars, which at a certain level became a metric that allowed for the settlement of the claim between the banks and the fund itself. To have gone into a bankruptcy would have been ruinously expensive. And that expense became a currency that we could use to settle these differences within the forbearance process. And working with Rick and Bob and others from our firm turned out to be just a remarkably collaborative process. And I think credit also should go to the banks and their lawyers and to the fund principals and their lawyers for a process that was conducted in the utmost of good faith and that led to a very good outcome. It was the professional highlight for me of the year.
And I think I can share, Bob Salvaggio and I at Rutter Associates and our colleagues at Rutter Associates share that view, Jim. This is one of the most interesting matters on which we worked and certainly have worked, and certainly the most interesting matter in a year that has presented any number of very interesting matters. With that, I think we can open this up now to Q&A. I'd like to turn first to Darrell, who I know has been listening patiently to Jim and me, and I expect will have at least a question or two for us. So Darrell, over to you.
Yeah, I have two questions, and I'm interested to hear what the participants are going to ask you as well. My first question is, the combination of Rick Grove and the Honorable James Peck is a very rare team of human capital that is not likely to be available every time this comes along in the future. You two have set down a template for how this kind of coordination problem could be resolved in principle, at least as a pattern. Do you think there's an opportunity to systematize this to the extent that an information technology firm, which are already used in the swap market to coordinate among dealers for compression trading, do you think there's an opportunity for a firm like that to collect the kind of information that you've collected on an ongoing basis or on an incident by incident basis, and somehow or other do a version of what you did that would not require such an exceptional team of people every time, to be done in a bespoke manner, as Judge Peck said?
That's a very interesting question. I'm interested in hearing Rick's response, but I'm going to give you mine. And I'm reminded of a dinner conversation that I had in Singapore with judges of the Supreme Court about a year and a half ago. And we were talking about the application of information technology and virtual intelligence to the jobs that judges do. I won't get into that conversation, but your question reminds me of that. And I was of the view that the skills of a mediator, for example, are predicated on all the data points of experience in terms of risk-adjusted assessment and the like. But there's absolutely no reason, when you think about it, that there couldn't be a model such as the one that you described, Darrell. The question would become, do the market participants have faith in that model, and are they prepared to turn themselves over to an algorithm? if the answer is yes, Rick and I are out of a job the next time this comes along. But I also think that there is a personal element here that plays a role. There's a question of trust. I don't think I am, by the way, the unique individual to do this. Any number of experienced former judges or experienced practitioners could step in the same role, provided that the parties in the particular setting have confidence in that individual. And the same is true for Rick. Rick, what do you think?
So I agree completely with what you said, Jim. I think that this is a template, as Darrell suggested, this is a template, certainly, for future resolution of these types of disputes, undoubtedly. Could some of the effort be undertaken by a firm like ours that simply puts all the trades through our models, or any other consulting firm with our capabilities, or another dealer that was not involved in the process put all the trades through, or even perhaps one of the trade compression firms that might have the capability, although I don't think the current ones are dealing in volatility swaps, but if they were, could they all be put through? Yes, and results would be produced. But as Jim indicated, the banks would still, I believe, be wary of those results. I think there's a human element that was very important in this process that would have to play a role. So I think there could be some possibility of deploying one of those, a firm like ours or one of those firms to provide a modeled allocation, but ultimately the negotiation would ensue and would require the kind of skill that Jim brought to this process.
Just a brief follow-up on that, and that was actually my second question anyway. Part of the difficulty, I understand, distinction between mid-market valuations and commercially reasonable replacement value. I've always wondered whether that part of ISDA contracts that stipulates the commercially reasonable replacement value is actually making the job that you had much more difficult. It's hard enough already with bespoke contracts like these to get to mid-market, but then thinking about what it would cost to replace one of those options on a covariance across two different stock market indices, getting that replaced, that makes it a lot more difficult to put a valuation on these. Is there a reason that you think is important enough to use that concept, commercially reasonable replacement value, rather than simply mid-market value on these kinds of contracts?
Well, I come at it from two perspectives, Darrell. One is, what does the ISDA contract entitle the bank creditors to? Had they been in a bankruptcy or other legal proceeding, what would they have been entitled to? And they would have been entitled to what the ISDA contract specifies, which is closeout amount, which is not mid-market, but rather something akin to fair value or replacement value, firstly. And secondly, in fairness, the cost of replacing these transactions, the more sophisticated transactions, would have been a wider bid-offer spread to mid-market value than the cost of replacing the more plain vanilla of these transactions. And so for those banks that had more of the sophisticated transactions in the portfolio with this hedge fund, it would have represented a less than equitable sharing of the resources. Jim, would you agree with that?
I couldn't agree more, but of course I don't understand anything you just said. I'm being slightly facetious, but
I know you are.
You're talking about a highly technical question. One of the things that we were focused on during the period of March to June, when we were dealing with this, we were looking back at a week in March that was at the height of the bell curve that Darrell showed in his slide. It was a period of extraordinary market disruption and panic in the markets. And so my recollection is that the bid offer spread described by Rick was so wide that it became extraordinarily difficult to determine mid-market or what would be fair. And it would kind of almost a hypothetical to figure out whether or not replacement was even possible. And in most instances, not possible. So part of the challenge for Rick was, and Bob was to look at a whole bunch of dealers' work, in fact, grading their papers as they were attempting to act in a commercially reasonable manner during a period when the whole notion of commercial reasonableness was itself a hypothetical because the markets were a little broken. And so part of what I think Rick was doing, and he can speak for himself on this, was to validate that the processes that the dealers engaged in, which weren't always the same, and which included proprietary models of their own, nonetheless adhered to a standard that could be validated by a neutral. And so part of what I think Rick and Bob did with consultation with me was to validate what each institution did at a time of crisis and concluded with few exceptions that what was done was reasonable.
Well, this is going to lead nicely, Jim. I agree with what you said. It's going to lead nicely into some of the questions. We have a lot of questions from our audience. I'm going to try to combine a couple of these questions so that we can get as much in as possible in the remaining 10 minutes that we have. A couple of the questions relate to how the process originated. So I want to get to those first. The first of those comes from Joe Scordata, who says, wasn't this process only possible because the fund had not yet filed for bankruptcy protection, which is somewhat unusual in a multiple dealer closeout situation? And then a related question that comes from Philip Haberbeck. How did the involved fund and banks come up with the idea to engage in such a process? Let's begin with that. And I think for that, I think turn to Jim, please.
I don't know the backstory completely. I only know the story as I became involved. It is absolutely true that if the fund had gone into bankruptcy, this process could not have substituted for the bankruptcy. It is possible, however, that a bankruptcy court could have sent the matter to mediation or to some dispute resolution process as an adjunct to the bankruptcy, but that would likely not have occurred early in the case. And the bankruptcy itself, I'm guessing, would have deteriorated into a whole bunch of separate litigation claims, including claims made as to what occurred prior to the bankruptcy. As far as the origin of the process, my sense is that the banks, at least some of them, formed a nucleus. There was an original group of 4, then it grew to 6, formed a nucleus of consensus that bankruptcy avoidance was worth doing, and that a process that allowed for an orderly and credible resolution of claims would be a good substitute. And I was simply picked as the means to their objectives.
A quick question that I'll answer from Bob Pickle. He asks, in addition to speculation and magnifying the promise of potential returns, and of course the risk of potential losses, were there other reasons for the funds and dealers to enter into these types of transactions? And the answer, I think, from the fund's point of view, is they were in the business of taking views and speculating on the market. That was their purpose. The banks were in the business of providing a market for the fund, and then on the other side of the bank transactions, providing the ability for investors in equities to hedge against volatility. And I think that's the crux of it. And there's more complexity to it, but I think that's the basic pattern. I want to turn to a couple of questions that relate to what the banks knew about the claims of each other. Stephen Cruft asks, in how much detail did each bank know of the other bank's claims and methodology? And Paul Cluley asks a similar question. What degree of information sharing between banks happened? Did they get to see each other's initial claim amounts and 60 notices, perhaps on an anonymized basis, to appreciate the nature of the portfolio of trades and to understand at a high level the methodology applied? Jim, do you want to start with that?
Sure. The the banks were identified by capital letters A, B, C, D, E, F. Maybe G, I forgot how many letters there were. So it was all anonymous. They had no visibility whatsoever into the specifics of each institution's methodology. And in fact, the overlay to substitute for that was the process that we engaged in. As I suggested a little bit earlier in the panel, part of what this process involved was well, if it's good enough, if what's happening to me is happening to each institution, I know that there's a rigorous process underway on claim validation. And that became the simulation, if you will, for actually seeing the underlying data. They were also able, I think, to make reasonable inferences, even from the anonymous array, as to which bank had which claim, partly due to the size of some of the claims, and some of the claims were quite large.
Joe Bauman asks, you said much of the dealer methodologies were commercially reasonable. Could you give examples of what you found that was not commercially reasonable, and how were those circumstances handled? How much did it change the claim? Very good and somewhat sensitive question. Let me say to that, Joe.
I want to hear how you answer that question, because I refuse to answer that question.
I'm going to say just this. There were in one instance, there was a bank that included something that was legitimate to include in the claim, but the other banks hadn't included that component. And we decided that it would be simpler to disallow or suggest that the bank that had included that component reduce their claim by the amount of that component, rather than going back to each of the other banks and asking them to calculate that component and add it. In another instance, there was what we thought under the ISDA definition of closeout amount was some double counting. And so we had some very, very lengthy discussions about that. We're running short of time, and I want to get to a follow-on that Paul Cluley had, and that I think will probably wrap up the questions that we're going to have time for. He said, depending on the answer to the question that he raised a minute ago, do you think the same consensual outcome would have been reached if perhaps the claims had been sold and were no longer being pursued by banks with a consistent and audited/regulated approach to valuation and risk? And I invite Darrell to comment on that if he has any thoughts, and Jim, you as well.
I would say that if there are unconflicted banks, that is, banks that did not have a relationship with the hedge fund, that running an auction, if there were sufficient number of them to create competition, that running an auction for those claims would have been a reasonable approach. I don't know the extent to which there are remaining dealer banks with the necessary valuation methodology that could have bid aggressively, but if there were, that's an intriguing idea, and I think it's worth pursuing.
Not only is it an intriguing idea, it's somewhat analogous to something that had been considered during the early stages of this process, which was to have banks within the lender group mark the claims on an anonymous basis so that there would be a source of data from sophisticated players that could become a means for valuation. I was actually thinking about the question in a slightly different way, which is, if the claims were sold not to sophisticated dealers in the market, but to speculative funds looking to take over the lender position, would it have been as easy to get to an outcome? And I doubt it. I think it would have been a complicating factor. I say that notwithstanding the fact that I believe claim trading within the Lehman case became a very effective means to produce a consensual outcome there. So I think it really depends on the circumstances.
I'm going to wrap up with just a very short answer to the to two questions that have come in from Loretta Hennessy and Julia Liu. How did we get the banks ultimately to agree? Did we give them a chance to amend? And the answer to that is ultimately they did all agree. There was a consensus on the part of each of the banks. They came to an understanding that what we were suggesting was fair, equitable. They had trust in Judge Peck and the work that we had done together, and ultimately came to the conclusion that this was a reasonable outcome, one that would be better than rolling the dice and going into a lengthy bankruptcy process that would be costly and time consuming. Having been on a trading desk and having dealt with this from that perspective, I understand that there's a preference for having some certainty in the settlement of claims, taking whatever hit that means in one's book, but being able to move on and get beyond that uncertainty.
I'd like to add, can I add one thing?
Yes,
There
of
was
course.
also a dramatic deadline on June 8th. June 8th was a put up or shut up. Here's my recommendation. Take it or leave it. No negotiation. This is the deal, or you're in bankruptcy. And that the dramatic deadline, I think, had a lot to do with crystallizing an outcome. It was fully consensual.
Absolutely. And so again, thank you very much to both you, Darrell, and you, Jim, for joining me on this panel, and Jim for inviting us into this very interesting process. Before I turn in just 60 seconds from now to some upcoming events that I'd like to talk about. I'd like to thank our sponsors for this event, Dwa Financial Technologies, FTI Consulting, Morrison and Foster, my colleagues at Rutter Associates for their sponsorship, and Lexus MLEX for their support. If you're interested in sponsoring a future Prime Finance event, please get in touch with Camilla McPherson, our head of Secretariat. I also want to note that Prime Finance is a not-for-profit and accepts donations through Friends of Prime. If you'd like more information, again, you can contact Camilla McPherson. I'd like to thank Camilla, who's head of secretary, for all the work she does on behalf of Prime Finance, and in particular, the excellent work that she has done in organizing these Prime Finance virtual events. I want to point out a couple of upcoming events that I think will be of great interest. The last in season 2 of Primetime Live will take place on the 12th of November, and the subject will be sustainable finance. We will then be turning to a series of Asia-focused sessions that will be of interest to others in Europe and the Americas, as well as our colleagues in Asia. But these sessions will take the place of what we had hoped would be an in-person conference in Asia this year, the first that Prime Finance was going to hold in that region. Instead, for obvious reasons, we've opted for a series of virtual events. The first of those will take place on December 4th at 10 a.m. Hong Kong, Singapore time. The second will be December 8th at 7 p.m. Hong Kong, Singapore time. And the third will be on December 10th at 10 a.m. Hong Kong, Singapore time. We're going to be talking about events that are occurring and issues that are arising across a broad spectrum of political, economic, market issues that can cause disruption to financial market transactions, and a look at how the resolution of disputes is being altered by the pandemic. So I hope that you'll join us, notwithstanding somewhat difficult time differences. I hope that you'll join us for these sessions. In conclusion, I just would like to thank once again Judge Peck, Professor Duffie, for joining me on this panel, for their excellent remarks, and to you in the audience for your attendance and your excellent questions. Bye now. Thank you very much. Bye for now.